I've been locked onto this chart for nearly 3 straight days now. Something feels off, deeply off. There's a detail hidden in plain sight that almost nobody is discussing. And once you see it, it completely rewrites what we think we know about Friday's collapse. At first, I honestly believed I was imagining it. I refreshed the data, I opened alternative feeds, I compared multiple chart sources, cross-checked timestamps, recalculated moves. The numbers refused to change. And with every pass, the discomfort grew stronger. What I uncovered disturbed me more than I expected. Let me walk you through it. This chart is silver, the Friday event. A brutal 39% plunge, the most severe one-day decline in modern market history. You already know this. Everyone knows this. Every headline screamed it. Analysts repeated it nonstop. YouTube exploded with reaction videos. Silver crashes. Retail wiped out. Trillions erased. That narrative dominated everything. But here's what almost no one is showing you. This is the chart that kept me awake for 3 consecutive nights. This is SIL, the Silver Miners ETF. These are the companies that physically extract silver from the ground. Real mines, real production, actual businesses with payrolls, machinery, infrastructure, and long-term capital investments. And this is where things start to feel very wrong. Mining stocks always amplify silver's move. That relationship has existed for decades. If silver climbs 10%, miners typically rise 20%. If silver drops 10%, miners usually fall 20% or more. This leverage effect is one of the most consistent patterns in commodity markets. It's practically textbook. Now here's the problem. On Friday, silver collapsed 39% from the peak, the most violent drop ever recorded. If history held, mining stocks should have imploded. 60%, 70%, maybe even 80%. That's what logic demanded. But they didn't. Mining stocks fell only 22%. I sat there staring at that chart, trying to process how that was even possible. The silver market was supposedly imploding. Trillions erased, retail accounts blown out, forced liquidations everywhere. Yet the companies whose entire survival depends on silver prices barely budged in comparison. It didn't add up. Then it hit me. Smart money didn't sell. Think about that for a moment. Institutional investors, hedge funds, pensions, family offices, the players managing billions with armies of analysts and access to data you and I will never see, they didn't panic. While silver was collapsing, while margin calls were rippling through retail accounts worldwide, they looked at their mining positions and said, no, we're staying put. Why? Why hold miners during a free fall? Why not dump everything and escape? There's only one answer. They knew something we didn't. They knew the crash wasn't real. That realization haunted me. And if that was true, if this move was staged, anticipated, engineered, then there had to be proof, a paper trail, evidence hidden in official records. So I started digging. What I uncovered made my blood run cold. Welcome to the hidden economy. If you're new here, this channel exposes what's actually happening beneath the headlines, while everyone else is distracted by surface-level noise. Subscribe now, because this level of analysis doesn't exist anywhere else. And if this video brings value, hit the like button. It helps push this information to people who need to see it. Now let me show you what I found. In my previous video, I broke down how this crash was carefully scripted. A 72-hour setup from Tuesday to Friday. A perfectly engineered trap. On Tuesday, Trump signaled support for a weaker dollar. For X markets, heard one thing. Weak dollar equals strong precious metals. The trade was obvious. Hedge funds rushed in. Retail piled on. Billions flowed in the same direction. By Thursday night, silver reached $121, an all-time high. Euphoria everywhere. Talk of $200 silver, $300 silver. Financial freedom, early retirement. Then Friday morning, 6:00 a.m. before markets even opened. Trump announces Kevin Warsh as the next Fed chair, a strong dollar hawk. The exact opposite signal, delivered by the same president just 72 hours later. Tuesday, weak dollar. Friday, strong dollar. That forced an immediate reversal. Dollar shorts scrambled to cover. Silver longs were liquidated, forced selling, forced margin calls, a 40% collapse in just hours. And through all of this, miners barely moved. If you missed that breakdown, the link is below. It shows the entire 72-hour timeline. But today goes further. Today is about who executed this. Let's start with something most people have never heard of. Spoofing. Spoofing is a manipulation tactic where traders place massive orders they never intend to fill. The goal is deception. Imagine wanting silver cheaper. You drop a giant fake sell order, thousands of contracts, creating panic. Other traders see it and start dumping. Price falls. Then you cancel your order and buy at the bottom. That's spoofing. It's illegal. It's fraud. And for years, the largest banks in the world used it in precious metals markets until they were caught. Between 2008 and 2020, 5 major banks were convicted, not accused, of rigging gold and silver, hundreds of millions in fines, federal prison sentences, J.P. Morgan Chase, September 2020. CFTC ruling. Manipulative and deceptive conduct spanning 8 years, hundreds of thousands of fake orders. Fine, $920 million, the largest in CFTC history. And traders didn't just pay fines, they went to prison. Michael Nowak, head of precious metals trading, convicted of racketeering. Greg Smith, convicted. Jeffrey Ruffo, convicted. Christopher Jordan, convicted. Real names, real crimes, real sentences. And it wasn't just J.P. Morgan. Scotiabank, $127 million fine. HSBC, $76 million. Deutsche Bank, $75 million. Morgan Stanley charged. 5 banks, all guilty, and none lost their license. These aren't theories. These are court records, government filings, public documents. And the fines? Pocket change. J.P. Morgan alone made over $40 billion in profit that year. So ask yourself, do you really think they stopped? Now look at Friday's data. This is the COMEX delivery report from January 30th, 2026, the day of the crash, published daily by CME Group. It shows who closed positions and when. Look at the stopped column. Contracts closed. Line 6061. JP Morgan Securities stopped 147 contracts on the exact day of the crash. They were short silver. Silver collapsed 39%. And at the bottom, they closed. Maximum profit. Perfect timing. They didn't exit early. They didn't guess. They closed at the low. Coincidence? No. Look again. Morgan Stanley, 31 contracts. Deutsche Bank, 58. HSBC, 60. Same banks. Same day, same bottom. Public data, anyone can see it. That's why miners didn't crash. Institutions knew this was manufactured. Then CME stepped in, margin hikes. Friday night, margins raised. Saturday morning, raised again. Another hike scheduled days later. Silver margins up 36% overnight. That forces liquidation, not risk management, execution. They didn't prevent the crash. They finished it. This has happened before. Same script, same tools, same outcome, and while paper prices collapsed, physical silver didn't. Dealers sold at $120, $150. Coin shops sold out. Golden State Mint shut down sales, couldn't source silver. That only happened once before, March 2020. The paper price is fake. The physical market is breaking. And here's what comes next. Shorts are covered. Weak hands are gone. Supply hasn't changed. Demand hasn't slowed. Industrial use is exploding. The physical shortage is real. When this turns, it will be violent. And when it does, most people won't be ready. This isn't a free market. It's a crime scene. The only question is, what will you do with this information? If this opened your eyes, share it with someone who needs it. Someone who got liquidated, someone who's confused, someone who deserves to see the evidence. Drop a comment, subscribe, stay alert. Because this isn't over. Now watch what happens.